Have you ever wondered how option selling works in trading? Or perhaps you've heard about it, but find the concept a bit complex? Well, sit back and relax. Today, we're going to demystify option selling, breaking it down into simpler, digestible terms. Option selling, often referred to as writing options, is when an investor or trader decides to sell options contracts instead of buying them. When you sell an option, what you're really doing is taking on an obligation in return for a premium up front. There are two main types of options you can sell, namely call options and put options. First, let's talk about call options. When you sell a call option, you're essentially giving the buyer the right, but not the obligation, to buy an underlying asset, like a stock, from you at a predetermined price, known as the strike price, before the option's expiration date. In return for this obligation, you're paid a premium. If the stock price remains below the strike price until the option expires, the call option becomes worthless, and you get to keep the premium as profit. But if the stock price ends up above the strike price, you might have to sell the stock at the lower strike price, which could result in a loss. Now let's look at put options. When you sell a put option, you're giving the buyer the right to sell the underlying asset to you at the strike price before the expiration date. Like with call options, you receive a premium for taking on this obligation. If the stock price remains above the strike price until expiration, the put option expires worthless, and you keep the premium. But if the stock price falls below the strike price, you might have to buy the stock at the higher strike price, which could also result in a loss. There's a few key points to remember about option selling. It can generate income through premiums, especially in a sideways or neutral market. But it also exposes you to potentially unlimited risk, especially if you're selling naked options, that is, selling options without owning the underlying asset. To manage risk, traders often use strategies like covered calls or cash-secured puts. In conclusion, option selling can be a profitable strategy to generate income, but it does require a careful consideration of risk and potential outcomes. It's crucial to thoroughly understand the mechanics of options and to have a well-thought-out trading plan before getting involved in option selling strategies. And there you have it, the world of option selling, broken down into simpler terms. Remember, knowledge is power, especially in trading, and understanding the mechanics of options can be a game changer in your trading journey.